Well, hello everyone and welcome to Momentum channel. My name is Mo, and in this video, we're going to be taking a look at our Smith Maneuver investment portfolio that we had with Questrade. We're going to take a look inside our portfolio, what positions we have, and which one of our positions we've recently added and bought more of in our portfolio. But what is Smith Maneuver? The Smith Maneuver is a technique that can be used by Canadians who have a principal residence, and they can take advantage of it to be able to turn their mortgage loans from a bad debt into a good debt. The technique is fairly simple and straightforward as long as your home mortgage is set up in the right way by having a re-advanceable mortgage, which provides you an option to tap into the equity of your home and by borrowing money from your equity and utilizing it to invest, that portion of your funds becomes tax deductible, allowing you to tap into the existing dormant equity in your home, invest it for the long term, and grow a portfolio and generate wealth by taking advantage of good debt. We've had other videos on this channel where we talk about Smith Maneuver in depth and introduce it in more details. For the time being, we wanted to just provide you an overview of what this technique is all about. Now, for us, as I mentioned, we've started our Smith Maneuver investment portfolio about 6 or 7 months ago. And currently, we are looking at this portfolio with Questrade with a balance of $72,000 roughly. We had one holdings when we started this portfolio. Initially, we only invested in VEQT, and in a moment, we're going to be diving into each one of these holdings and explain what they are each all about. We've added to our existing shares of VEQT over the past week. We're going to talk about that. But recently, we started a smaller position in XDIV. Here, the focus is a lot more on the dividends, and we'll talk about XDIV in a short moment as well. Let us take a look at this portfolio though and our performance over a span of time. If you look at the past 15 days, you'd see how the balance has evolved over time. The past 1 month, definitely the balance value of this account has gone down. The 3 months also showing the balance has gone down, and this has a lot to do with the overall status of the market. Even though we've added more deposit more funds to our accounts, the market has been really on a horrific run so far this year, and that really has taken a toll in terms of our performance of the portfolio. We're looking at the total profit and loss of negative 11%. That translates into a total profit, or in this case, total loss of close to 9,500 at this time. But we are not worried with that. The fact of the matter is we are here for the long term. This portfolio is fairly new, and as I mentioned, overall the stock market has done poorly. But the fact that we are invested in index funds that allows us diversifying our investments doesn't really worry us at all. In fact, we are here for the long term, as I indicated, and we are trying to take advantage of that and add to our existing shares of these funds. Let's take a look at a number of shares with VEQT, which is Vanguard Investment Canada Incorporated, with ticker symbol VEQT. It's available on Toronto Stock Exchange. As the name suggests here, your exposure is 100% to stocks, but it's a geographically diversified fund, total exposure to equity markets. We are showing that in the past 1 week, this fund, VEQT, was down by about 1%. If you look at the past 1 month return for that, it's down by close to 6.5%. The past 3 months, VEQT is showing to be down by close to 7.5%. And in the past 6 months, it is down by 14% plus. Quite a bit of a decline for VEQT. Now, if you look at the 1 year return, it is now in the negative territory, 1 year return of negative 4%. The maximum time frame, if you look at it, this fund has its inception back in 2019, and since then it's still up despite some of these declines, about 26.5%. As I indicated, we have 2,235 shares of it, and this one in itself is down by close to $9,496, or down by 11.7%. Some of our recent purchases for VEQT includes we bought 1 share at the price of $32.26. We bought another share at $32.05, and a number more. If you look at it, bought at $32.25, $32.59, $32.55, as well as $32.74. Really, you see our approach, buying in small quantities, but gradually adding to our existing shares. Currently, our average share price for VEQT is at $36 and close to 38 cents. That's our average purchase price. Given that the stock price is less, for this index fund, we plan to continue to add gradually to our existing shares. The other position that we started to add over the span of the past 1 week is XDIV. XDIV is iShares BlackRock Core MSCI Canadian Quality Units on exchanged on a Toronto Stock Exchange, and the focus is on dividend-paying high quality stocks, Canadian stocks. If you look at the performance of XDIV, its all-time return, and this inception goes back to mid 2017, is up by close to 23%. Its 5-day actually return the past 1 week is slightly up by 0.16%. The past 1 month's return is down by 6%. 3 months return is also showing to be down by close to 3%. 6 months return is positive, close to 3%, and 1 year return for XDIV is at up close to 8.7%. We're going to be talking about XDIV in further details, but if you look at our average purchase price here for our account here, this account for Smith Manoeuvre, we have 6 shares of that at an average price of $25.14. We did have 1 shares in our tax-free savings account, 1 in our other margin account, and that's why you see those details here as well. But this is the focus of our Smith Manoeuvre, as you noticed it here. Some of our recent buys, if we focus on that, include buying it at the price of $24.86. We also bought it for our Smith Manoeuvre account at the price of $25.09, and a couple of others, $25.03, $25.27, $25.25, $25.34, and $25.32. This was replaced, and we bought it at $25.34. Those are really some of the purchase that we've had. Currently, it's down by $1.31 in this account in our Smith Manoeuvre, or down about just shy of 1%. Now, as promised, we are going to be taking a look at these 2 specific holdings that we have, those 2 index funds, and talk about them, review them, and share with you why we've decided to pick these 2 for our Smith Manoeuvre portfolio. Let's get into it. All right. XDIV, or iShares Core MSCI Canadian Quality Dividend Index ETF, available through BlackRock, has been actually one of our recent picks, as I indicated. Why XDIV would be a suitable options for investors such as myself is the fact that it offers a low-cost portfolio of Canadian stocks with above-average dividend yield and steady or increasing dividends. We wanted to get exposure to more dividends, and rather than going and picking dividend stocks separately to have to do a lot of research on our own, we opted for this low-cost indexed ETF focused on dividend paying Canadian stocks. Makes it easier through Questrade. When you buy ETFs, you don't have to pay a fee when you buy them in low quantities. Whereas if you were to buy a stock, no matter the quantity, at least you would be paying a fee of $4.95. So we wanted to stay away of that and also get that passive investments approach there. Some of the other reasons is it's designed to be a long-term core holding and seeks to provide long-term capital growth by replicating the performance of the MSCI Canada High Dividend Yield, a 10% security capped index net of expenses. The past return for XDIV, the 1 year return at the end of April of 30th, 2022 was showing to be up by 17.5%, and the 3-year annualized return was 10.77%. The annualized return since inception for XDIV at the end of April 30th, 2022 was 9.7% annualized, which is quite decent return. This fund is actually rebalanced on a semi-annual basis. So in a sense, make sure that your exposure is not out of whack depending on how the performance of the underlying assets are. Its inception goes back to June 7th of 2017. In terms of its net assets, we are looking at $707 million in assets under management. It does currently have a distribution yield of 4%. And if you look at the 12 months trailing yield is at 3.84%. What's interesting about this is that it is available for DRIP or dividend reinvestment plan, and it does pay its distributions on a monthly basis. So could be wonderful for investors who are looking for some sort of a passive income. And for our case, we would like to utilize the distributions and over time collect and buy more shares of XDIV. So that's our plan. We don't intend to touch that funds, but it would be nice to know that long term, when this portfolio grows to a much larger size, you have built a solid machine of passive dividend distribution income. In terms of its business involvement, it is nice to see that it has almost zero exposure to controversial investment pieces, and it is also considered to be very environmentally friendly as a result. In terms of the fee, as I mentioned, it has very low fee, only a fee of 0.11%, which means if you invested $10,000 in 1 year, you would be paying only $11 in fee, quite low. Its risk indicator is at medium level. And in terms of its holdings, if you look at entire holdings list, which is not that many, in fact, you're looking at 25, your exposures based on the highest weightage from highest to lowest, you're looking at exposures to Nutrien, TC Energy, Royal Bank of Canada, Toronto Dominion Bank, Bank of Nova Scotia, Canadian Imperial Bank of Commerce, Manulife Financial Corporation, Sun Life Financial, Fortis Incorporated, Rogers Communications, Power Corp, Emera, Shaw Communications, TELUS, Algonquin Power, Hydro One, Great West Life Co., Kiora Corp., IA Financial Incorporated, Canadian Utilities Limited, BCE Incorporated, Quebecor Incorporated, IGM Financial, and you have minimal exposure to Canadian cash and US dollars cash. All of these companies are indeed Canadian companies. In terms of the exposure, as we talked about by sector, majority of the exposure is to financials, close to 53.37%. Utilities is the next biggest sector exposure with about 13% exposure, followed by energy, materials, communications as the major kind of sectors that you have exposure to. We have made a video recently on our channel talking about the 11 stock market sectors and providing examples of them. It might be a video that might interest you, so I will add a link to the here to the description as well as a card so you can check that out. Now, the other pick that we had in our portfolio, which we have a ton of shares of, is VEQT or Vanguard All-Equity ETF Portfolio. It also has a minimal fee at management expense ratio of only 0.24%, quite decent for an all-in-one exchange traded funds. We've talked about all-in-one exchange traded funds in depth. They give you a diversified approach to different countries. It is rebalanced frequently and has $1.9 billion in assets under management for VEQT. Looking at the distribution frequency here, we are looking at a distribution frequency of annual. So it does pay its distributions only on once a year. Its inception goes back to 29th of January 2019. And the fund seeks to achieve its investment objective by primarily investing in equity securities. Looking at the performance for VEQT over the span of the past timeframes, this is since its inception. And the time frame, if you look at it, is again as of end of April 2022, which is comparable to that of the XDIV that we looked at. Looking at that, the 1 year return was showing to be at 1.2%, 3-year annual return of 8.3%, and the annual return since inception was at 10.7%. Quite decent for all in one indexed fund. Here, if we look at the allocation number of stocks, you're looking at 13,657 different stocks kind of coming together to form this VEQT. We don't have any exposure to bonds. As I mentioned, 100% of your exposure is to stocks. Now, the underlying funds within VEQT consists of other Vanguard ETFs. Your biggest exposure is to US Total Market Index ETF, about 43%, followed by FTSE Canada All Cap Index ETF, about 30%. FTSE Developed All Cap excluding North America Index ETF. This gives you more of an international exposure, around 19%, and Emerging Markets All Cap Index ETF, about 7.4%. Your exposure is mainly to large cap companies at around 79%, followed by medium-sized company at about 9%, small companies at about 5%, and about 4% into medium small, and the remaining balance of medium large is around 3%. In terms of the exposure breakdown by country and geographical locations, your biggest exposure to the US at 43%, followed by Canada at 30%. Then you have exposure to Japan, United Kingdom, China, Switzerland, France, Australia, Germany, Taiwan, and these top 10 countries account for close to 90% or 91% of your exposure. The remaining part is to many other market allocations, but at much smaller geographical distributions. In terms of the sector breakdown, your biggest exposure is to financials, that's close to 19%, followed by technology, industrials, consumer discretionary, healthcare, and energy. You still get exposure to the remaining stock market sectors as well, and that forms the overall 100% exposure for you. In terms of the biggest companies that we are concentrated as part of VEQT, your biggest exposures are to Apple, Microsoft, Royal Bank of Canada, Toronto Dominion Bank, Enbridge, Amazon, Bank of Nova Scotia, Canadian Natural Resources, Bank of Montreal, and Canadian National Railway. If you want to look at the remaining holdings, you can click on this button on the page, and it shows you and exports into one file all your holdings that you're going to get through VEQT. As we talked about it, there's a historical prices provided here. So there's some good information here on the Vanguard website that's provided to you, the breakdown of your annual distributions and how are they kind of broken down between capital gains, income, and so on and so forth that is provided for investors. Looking at the past distributions, for example, in the year 2021, the total distributions was close to 64 cents per share. In year 2020, it was at 46 cents. And in year 2019, it was at 40 cents. You see how each year since their inception, they've increased their total distribution so far. Well, there you have it, folks. A quick look into our portfolio that we have with Smith Manoeuvre and the holdings that we currently have and our plans for this portfolio. We definitely intend to add more shares of our existing picks, both VEQT and XDIV. VEQT more so from a growth perspective, not so much counting too much on a dividend income. Whereas for XDIV, our focus is really building that solid dividend paying ETF index fund for the long horizon and long term. Are you invested in any of these ETFs in your portfolio? What index funds or ETFs are you currently eyeing on and planning to add to your existing shares in the stock market? Let us know in the comment section down below and share what your thoughts are. I hope you found this video beneficial and gained something of value from it. Of course, this is not meant to be a financial advice, but more so sharing of our best practices that we've learned to thin and thick, and what we've learned over the time as we've invested in the stock market. More so intended for entertainment and sharing our lessons learned. Thanks again for watching this video until the end, and I hope you have a wonderful rest of the day. See you next time.